Good morning. Oh, okay, yeah, that's fine. Good morning. Today is Sunday, February the 6th. Thank you for joining me. I'm sure people will start trickling in a minute. Um, Last week I forgot to, I don't know what the word is, host the thing on YouTube, whatever. YouTube like records it and puts it up there, which is how I've been sending those links. And last week I forgot to click the little stream button. So this this week I made sure to do it. Um, I Well, maybe I should wait for this for just a minute. I'm sure some more folks will trickle in. It's just about the Burr worksheet there. Um because that what I sent with the email I think is the wrong version. And I have a better version. It's not much different, but it'll do the mortgage calculations for you so you don't have to figure that stuff out. I uh I often use a website. I think I've shared it with you. Oh shoot. I think I've shared it with you here before. It's called dinkytown.net. And dinkytown.net, if you're ever, you know, out and about and you can't get to your computer and like look at the analysis sheet or do your math however you like to do it, dinkytown.net has got every kind of financial calculator you could want to use. And then some, a bunch of other weird calculators that aren't financial, but you still might want to use. Because it's like a website some guy made that's nothing but calculators, and it's amazing. I highly, highly, highly recommend. If you need to run some numbers. And excuse me, the website is I don't know if it is made by a Canadian guy or if he just picked Canada as one of the places he was going to support, but it has a full like Canadian and French Canadian suite of calculators for like all sorts of stuff, right? You want to calculate like the amortization on your vehicle, right? You can do that. Dingytown will let you do that. You want to calculate your credit card payoff time? Dinkytown.net will let you do that, right? People, uh, get themselves into trouble because they don't really calculate out how much money they should be saving to achieve a certain level of retirement. Dinkytown.net will do that for you, right? It does calculations of all of those things. So it's very, very useful in that regard, right? And then let's see what else here. I mean, they got all kinds of stuff. You know what, actually? What am I doing here? I don't know if here actually. What am I doing? I can show you what dinkytown.net does if you haven't seen it before. Yeah, just present my whole screen there thing. There we go. So, just for the record, this is dinkytown.net. Sorry, I wasn't at home. This is what it looks like. It's a very simple website. It's just a bunch of financial calculators. But if you follow up here, you go to Calculators Plus, and you click and you scroll down, you'll see it has Canadian and French Canadian calculators. So if you go to Canadian calculators, it'll give you all these different calculators that it does for you. And most of them are financials. You see, right? They're like loan calculators and buying calculators, stuff like that, investment calculators. So you've got all these different calculators you can use if you just go to dinkytown.net, and it'll let you just do it on the website, right? So I'm going to go to the mortgage calculator, right? And obviously, my analysis sheet, for example, has one of these built into it. But for if you're on the road and you don't have access to your computer, but you want to run an analysis on something, well, you can figure out how much your mortgage is going to be right here. Um, and obviously, you just throw in your amounts and your amortizations and your everything, and it'll pop everything out for you. One of the things that's very cool about this mortgage calculator is if you click on View Report at the top here, it's kind of separate from the rest of the calculator. But if you click on that, then it will give you your repayment schedule. So every year, your principal and your interest, right? So you can calculate very, very quickly what your principal recapture is going to be because it calculates it for you nice and easy. So that's dinkytown.net. And it's a great, great way to calculate things if you're not going to use a spreadsheet. Now I sent today, with today's invitation, link, email, whatever. I sent out this BRRRR breakdown spreadsheet, and I realized I think I sent you guys the old file. I had made it originally, and the way that it worked was everything was very manual. You had to like type in what your mortgage payment was going to be. Type in. You're just kind of estimating all those things and typing them in. And I was going to tell you, use dinkytown.net to calculate what your mortgage payment is going to be if you don't know. But I changed my mind about that, and I made another version where I took my mortgage calculator from the analysis sheet and I integrated it into the BRRRR breakdown. So I'm gonna send this to you at the end of this seminar because I didn't send it with the email, so I will send it right after we're done. And on this version of the sheet, it's more or less the same thing, but now it'll calculate the mortgage for you. So it's a little bit more just a teensy bit smarter. So you have to do a little bit less work. But let's just go through what this calculator does really, really quickly, and what you'd use it for, and how I use it. I've used it a couple times to estimate a BRRRR or a potential BRRRR. You could technically use it to estimate some other things as well, but I mean, it's primarily the idea is that you're looking for BRRRR opportunities, right? You can obviously I think if you're investing, obviously you should be analyzing like a regular analysis, and I don't mean my spreadsheet. I just mean those are the numbers, and those are the numbers and the things that you should be thinking about and understanding. Excuse me, to kind of make a decision on whether you think a property is a good idea or a bad idea. The purpose of the BRRRR calculator is more once you've found a property that you think is a good deal, you maybe haven't quite decided yet, but you think that this is the right way to go. Then you come to this calculator and you type in the raw numbers to get a better estimate of what your BRRRR would look like, right? So take you through that really, really quickly. I've got probably a property here somewhere. No, I don't. Yes, I do. There we go. So I've got 91 Highland Drive here. It's a $5,500,000 property in Hamilton. I'm going to fudge the numbers a little bit to make the BRRRR work, just to demonstrate the principle. But I wanted to use more or less real numbers for this. So this is 91 Highland. And in here, you'll notice first thing, unlike the other one, you don't have to put in information about the property because we don't care. We're just calculating the numbers really, really quick and dirty, for lack of a better way to put it. Right. So this property has a purchase price of $549,900. Right. So throw that in, obviously. These gray cells are all automatically calculating for you. So in the version of this sheet that I will be sending to you, these cells are locked. You cannot change them, but they are not hidden. So you can see the formulas and understand the math if you're so inclined. And if not, then you can use it and know that you won't break it because it's all locked up for you. So here we put in the relevant details, right? What's our interest rate? How many years are we amortizing for, et cetera, et cetera. Oh, there you go. I found the bug that shouldn't be protected. How many years are you going to amortize for, et cetera, et cetera, et cetera. And then here it'll calculate for you your principal recapture over the period of your BRRRR. This is a bit clunky because it takes the average of your first year and multiplies it across how many months you're going to be your monthly average for your first year, right, in principal recapture, and then multiplies that across how many months you're going to carry the property for. So if, for example, you did a BRRRR that was exactly 1 year, then this principal recapture number is exactly accurate. But if you do any number higher or lower than that, then this is an approximation, right? Because it'll be off by a little bit because we took the average rather than absolute numbers. And that is because if you did not know this, the amount of principal you capture changes every single mortgage payment. So it's a pain in the butt to do math on in something like an Excel spreadsheet, unless you're going to have tables and tables and tables. And I didn't want to do that. We've got obviously our down payment here, so it's going to calculate for you automatically your down payment. Here right now, this down payment is 25% of the purchase price. Over here in the control panel, you can see that's because I have commercial selected. You have the option. You can pick a residential Damn it, there's a whole thing protected right now. You can how do we unprotect this? You can pick either a residential or a commercial property, right? And there we go. So just drop down, they'll drop down, pick residential or commercial. So I'll actually go to residential because I'm not going to buy this as a commercial. So here it's going to tell you your principal recapture, like I said, your down payment, right? It's going to give you your closing costs, right, which is calculated down here because this is a bit of a summary of everything, right? Your closing costs, your renovation costs. Your renovation costs are going to be totaled over here. I just realized I'm saying over here, and my mouse, I know exactly where it is, but it's a little delayed and a little small. So hopefully everyone can see it. Please, someone say something if it's hard to see, or if you're listening, then I apologize. I'll try to be a little more descriptive. There's a table on the right hand side that will total your renovation expenses. You're gonna put in all of your estimated renovations, and it'll total everything out, and then output that in this left hand summary as a renovation cost. We then have, of course, carrying cost. Again, there's another subsection where we'll calculate that. This is just kind of the overview. And we have our cash expense, right? So how much of our cash are we putting into this deal, right? Because this is a burr. So that's going to total, that's going to sum up your down payment, your renovation expense, so all that stuff, right? I think van transfer tax, legal, all those things go into your cash expense, right? Then it's going to tell us what the total cost of the property is, how much profit we're going to make off of the property if we make any, and then it's going to also tell us what our liquid profit is, right? Because this is a BRRRR deal, which means we can only pull 80% of the value out of the property, right? So sometimes you may be in a situation. Actually, this property is an example, right? So you can see on the screen here, this property here is a purchase price of 549.9, right? And we targeted an after rental value of $700,000, right? So if we hit that number, right? 'Cause these are assumptions, but if we hit that number of $700,000, then our total profit, right, would be $156,000 approximately, going from 549 to 700, right? There are the expenses that came out, of course, which is why that doesn't quite add up evenly. And then we have our liquid profit, because we don't get $700,000. We get $560,000, right? That pardon me, that is our um oh, yeah, that is our refinanceable amount, right? The amount that we can pull out. So the reason why I differentiate between profit and liquid profit is because there's a bunch of money you might make that's stuck in the house. It's not liquid to you. And then there's the money you actually get to pull out, right? And so a good way to look at liquid profit is if it's negative, that's just saying how much money do you have to pay on top of your closing costs to make this burr happen, right? So a lot of the times when you're looking at an investment, obviously you're going to have expenses above and beyond the purchase price of the property or the asset, right? And all that this is really doing is calculating what those expenses are going to be, approximating them as best as it can, right? To give you a better idea of how much of your money you're actually leaving in the deal, right? So in this case, like liquid profit, that means that this deal in total was costing you $10,000 out of profit, right? You made $156,000, yes, but you had to put $137,000 into the property, right? So after you take back your $156,000 over your 137 that you put into it, the difference now is 10,000. Now, actually, that's wrong, right? According to my math, right, $137,000, and then we made 156. I should have a profit of almost $20,000, right? But unfortunately, I have other expenses, right? I had my carrying costs, right? So in this case, I had $25,000 almost of carrying costs, right? So now that's hurting me, and I also had um what else I had? I also had my closing costs. That's right. So I had my closing costs and my down payment, which that became my cash expense, and I had my carrying costs, which is in addition to that because I hold the property for 12 months while I'm doing the burr, right? So when I put those two things together, That works out to like 170 or $180,000, and then I only made 160. So in total, it's losing me money essentially. It's costing me money to do the burr on this house to the tune of almost $11,000. Right, liquid profit is negative $10,941. Or in other words, 1 year after the purchase of this house, the renovation of this house, and the eventual refinance of this house, I will be $10,941.52 poorer than I was before I bought this house. So the year before, right? So that's what that means essentially. So I don't want, forgive me, I'm not trying to belabor the point, but I just want to make sure that you understand, right? When I say that, I mean this is your total um money out of hand. Yes, Elias.
Can you go over the carrying cost again? What was that again?
Oh, sure. Well, I'm gonna get to that. So I haven't covered it yet. So
Oh,
we'll
okay.
scroll down to that now.
Okay.
No need to apologize. The refinance time. So this is the last thing in kind of our burr breakdown. This overview is just the time in months. Is it gonna take you 6 months, 12 months, 3 months to do the burr, whatever, right? Here we then have our subsection closing costs, obviously land transfer tax, legal, misc, inspection. These are all things I leave for you to input and estimate yourself. Land transfer tax. Well, you can just Google the formula for land transfer tax. It's a little tricky because there's a lot of like, it's what's the word? It's like bracketed, right? So depending below 100,000, 100,000 to 250,000, 250 to 400, 400 plus. I think now there's a new like half a million plus or something like that bracket. So it gets a little tricky to calculate. But if you just go online, you just type in land transfer tax calculator in the Google, it'll just come up. You type in how much money, and then you just throw it in the sheet. So that's real simple. That's just going to total up your closing costs. Estimate, right? This is not something that needs to be perfect. This is not this is not a university exam or a midterm test. It's just an estimate. If you're off, if you're off your closing costs by a few $1,000s, then just financially live your life in such a way that you can afford to absorb the $3,000 that you're off, right? Just margin, always you're leaving some margin, right? None of these calculations needs to be exact because you're not expecting things to be exact, right? You leave a bit of margin for yourself so that you can adjust if things don't work out the way you want them to. Carrying costs, Elias, to your question. So, carrying costs are obviously the expenses you incur while you're working on the project, right? So, just to make it really simple, instead of talking about a burr, I'm just going to talk about a flip for a second because I think it's a slightly simpler illustration. I'm going to buy a house and I'm going to flip it, let's say, right? So, I buy, I don't know, let's say a duplex and I'm going to flip it. And I talk to my contractor and it's going to take me, that's just because it's on the screen here, it's going to take me 12 months to do the flip, right? Well, what is flipping, right? Flipping means I'm kicking the people out and I'm renovating. That's what a flip is, right? So normally when I buy a property, it's a cash flowing asset, or at least it's an income producing asset, even if it's cash flow negative, right? Obviously, while I'm in the process of the flip or the burr, and those tenants are evicted or otherwise not there or not paying, right? Then I still have the expense of my mortgage, my utilities, my insurance, my taxes, all of those things I'm paying every single month, even though I have nobody in the property who's paying me rent to cover those expenses, right? So those are my carrying costs, right? All of those things that I have to pay for, regardless of whether or not somebody comes in and pays me any money for my asset. And they're important to factor, right? Because your carrying costs are not very much necessarily, right? Maybe $2,000, $3,000 a month. I mean, bigger property, maybe 5, 6. But like in the scheme of things, we're talking about buying houses for hundreds of thousands of dollars. Carrying costs are not necessarily that much. Uh, Thing about carrying costs, of course, is they add up. 1 month of carrying costs will not kill you. For those of you who can see on the screen, you can see here I've got a month of carrying costs for this property, and they total out to $3,204 per month. So that's not that much money, right? I mean, I don't want to spend $3,200 and get basically nothing for it, but it's not going to bankrupt you, right? If you kind of miscalculate this a little bit. But of course, you don't pay the carrying cost for 1 month. You pay it for the duration of the project, right? So again, if we say this is a 1 year reno, I have to pay that $3,000 per month for 12 months before there's anybody who moves into the house to pay me rent, right? So I need to know this up front so that I have the money on hand to pay these expenses, right? I go into the project with my eyes open, knowing how much money it's actually costing me, right? Because it would be very easy to calculate the purchase price, right? And maybe the cost of the renovation, and then ignore my carrying costs, right? And let's say my project is 1 year project. Well, here we can see my total carrying costs. So again, that's all of these: mortgage payment, property tax, insurance, utilities, all of those things multiplied by the duration of my reno, which in this case, my refinance time is 12 months, right? That's $38,456 at the end of the year, right? So carrying costs add up. Obviously, I was saying before, $3,000 is, I don't want to say that it's not a lot of money or anything like that, but I'm just saying it's an amount that we can all probably afford. You can scrimp and you can save and you can move some things around. You can find $3,000 at least 1 month, probably, right? Again, maybe your average Canadian can't, because my understanding is the average Canadian doesn't have that much savings, but you're all trying to be investors, right? We're all trying to be investors here. So hopefully you at least have decent enough money habits that you have a little bit of savings and you can absorb that, right? But whether you're try and be an investor and you have good money habits, or whether you're somebody who knows nothing about finances and you have very poor money habits, most people cannot afford a 38 or $40,000 unexpected expense, right? That is something that is much less affordable, right? And so it's something you should be aware of going into your deal. Have your eyes open and understand that you're going to incur this cost month over month, right? And it's something you have to factor in. It's also a lever, right? This is a very important and beautiful thing right here. This carrying costs and refinance time is a lever. It's something that's under your control, reasonably under your control, anyways, that is determining how much money this deal costs you. So, just to make the point, if I go over here and I change my refinance time to 6 months, my total carrying costs are obviously cut in half, right? My deal just became 20% more profitable. And if none of the other numbers change, right, I should now make more money, which now I have less carrying costs and I should have. Uh, Wait a second. What just happened there? Oh, yes, yes, yes. That's right. That's right. That's fine. That's fine. Yeah. So if I have less carrying time, I'll have less carrying costs, and those will save me money. Sorry, I got confused because I was looking at my liquid profit, and it became less profitable as time decreased, which is doesn't make sense based on what I'm saying. But I'm forgetting that the sheet's doing a little bit of extra math that is causing that to happen. So there is one last field here after carrying cost. There's income. Okay, a burr is not a flip, right? So I said if you're doing a flip, you kick everybody out and you flip the house. And so if your project is 12 months, that's 12 months where you don't collect rent. Um, Burrs are not necessarily like that. Pardon me. It totally depends on the burr. Every project is different. In some projects, you are going to want to kick everybody out and flip things over. In other projects, you might take a more piecemeal approach, right? You might go unit by unit. So if we were to use the example of, if we just go back here to 91 Highland Drive, right? This right here is a fourplex. So in this property, maybe we're going to kick out unit one, right? And work on unit one, but we're going to keep units 2, 3, and 4, right? So in that circumstance, we're going to have some income, right? So our carrying cost is not going to be the full mortgage, property, insurance, utilities all stacked on top of us because we have people in the property, right? So here I've left a section where you can put in your estimated monthly rent, right? And it will calculate for you both your it will calculate for you your rental income for the project period, right? So if we say 6 months, we say 12 months. And so that's what was offsetting my profit there, was reducing the amount of months, reduce the amount of rent I collected. And in this case, I've estimated a ridiculously high rent. So chances are this property would not get quite this high of a rent. I would actually estimate rents in the property like this are probably close to like that amount, maybe closer to like 44 or 45, but somewhere nearer to there. But anyways, when you put in that rent amount, it's going to use that to offset the expenses of your carrying costs, right? So obviously, if you're paying out, I don't know, $6,000 every month in total expenses for the property, but you're collecting $4,000 in rent, the real net cost to you is $2,000 a month, right? $24,000 over the course of the renovation, as opposed to, triple that if we're talking about $6,000 per month, right? So it's just something there to make it clear that if there is some income coming in, you're not covering all of the carrying costs, right? And then the last thing here on the right hand side, we've got this table, the renovation list. Here you just type in your renovation, right? So we've got to replace floors in kitchen, right? We've got to do cabinetry. We've got to do Aaron can't spell, so we've got to do paint. We've got to do wiring because it's knob and tube, right? Right. So you put all those things there, and then you can choose your timeline. So obviously, when you are looking at a property and you're serious about it, it's either something you've bought or you're really seriously considering buying, right? You're going to want to start identifying pain points. You're going to want to start identifying pain points, I guess, the things in the property that need to be addressed, right? And you're going to walk into this property and you're going to see things that need to be addressed yesterday, and you're going to see things that we'll get to it. All right. So here, this chart allows you to make a list of all of the renovations that you think are necessary for this property in the short term. Now, by short term, I mean the next 5 years, right? Which is not actually that short a term, but in the short term, that's what I mean. In the next 5 years, what do you think is necessary in this property? Is it going to need windows, a roof, the driveway paved, whatever, right? Whatever the thing is that it's going to need, right? You put those down into this renovation list chart. Now, obviously, there's a huge difference between, let's say, the windows, if you think they need to be replaced 5 years from now, right? And I don't know, the stairs up to the property are rotten and they need to be replaced yesterday. Please hang on a sec. I have a small dog who's annoying. Hey, Pete, what's the matter? Don't come back. My apologies. Yeah, so there's a big difference between obviously something that needs to be done today and something that needs to be done, in the foreseeable future. So here you can list out all of the renovations, whether you think they need to be done immediately or not, and you can identify what your timeline is for getting them done, right? So obviously immediately, 3 months, 6 months, 12 months, 2 years, 3 years, 4 years, 5 years. I don't go past that because that starts to get ridiculous. But those are what you can calculate out. It is important to know that I don't consider things that you're going to do a year or further out to be a part of your renovation cost. So if you put something down here and you say, "Oh, I'm going to get to it in 3 years," that's cool. The spreadsheet will not calculate that as your renovation cost. It will ignore it, right? So let's just say we got to do cabinetry immediately, painting immediately, and we're going to replace the floors in the kitchen. Here, you're going to have to, and this is just learning and experience and talking to people, you're going to have to estimate what your costs are, right? So let's say to replace the floors in the kitchen, I'm looking at, I don't know, I'm going to pay someone to do it. So let's say $650 per square foot. And let's call it $6,500, which that's really expensive for a kitchen. Actually, it's called $3,500. Same thing. Cabinetry is not cheap. Let's say cabinetry and countertops, let's say 12 grand, and we're gonna paint things, and let's just say the whole house. It shouldn't be too expensive. Wiring, I've never had to replace knob and tube wiring. I actually don't know what that would cost. It's probably would depend on what's going on in the house. It's probably quite expensive to replace. Also, I don't know how you'd find a house that has that in it, because that would basically mean nobody's bought or sold the house in like 40 something years or something. It's getting much harder to find a house with that in it today. Maybe in a section, Like, you've had a house that's been renovated a couple times, or they put additions on it, and like the old parts got it. I could see that more, but like finding a whole house with knob and tube in it would be very, very unlikely. Like, even if you're the owner of that house, like, it would probably be more profitable for you to just do the reno before you sold it. It's hard to say, but um, I don't know. Anyways, so you can put things in, and as you can see, it'll calculate things for you. You can put up to 20 different little projects into the spreadsheet if you want, and you can see at the bottom it's gonna calculate things for you. It's gonna give you the total and the immediate total. So the total is, of course, all of your estimated renovation costs. Anything you think is going to go into this property in this project, it's going to go into the total, whatever cost you put down. But the immediate total is only things that are within the timeline, right? So if I take this $2,500 and I change it to 3 years, you'll see my total. Uh, oh, that's that's good. I caught that. It's calculating them backwards. But my total and my immediate total, it should be the other way around, but they update, right? So only the things that you're expecting to spend money on will be totaled as immediate total. And then over in the BRR breakdown, only that immediate total is used for a renovation cost, right? So you see here the $18,000. Oh yeah, that's so weird. And it calculates correctly, right? So if I say paint and I go to thing, but they're labeled incorrectly, right? Then my renovation cost now decreases because I've taken that $2,500 cost and moved it into the future. Right. So that's the sheet in a nutshell. It's very simple. Certainly, obviously I've done this a bunch of times. So to me it's very, very simple. Hopefully it's not very confusing for you. Um it calculates a lot, but also it's not actually necessarily doing that much. But what this should be doing is when you have a good idea of what your BRR project looks like, this is just a way to double check your numbers and be able to move forward with a bit of confidence to know that you've looked at it, all the aspects of it financially, before you go ahead with your project. Uh, there are, of course, some pain points, right? Some things that you should definitely be aware of. The target ARV. This entire spreadsheet more or less depends on this number. The target ARV is just what you think the property is going to be worth after your BRR. It is obviously a guess, right? And it's subject to being wrong and being an idiot, right? These are both things that could happen. So you got to do your best to try to justify your estimate. You don't need to do it in the sheet, but just to yourself, right? It's just like when you're getting comps, right? When an appraiser gives you comps, they justify them. This property is like your property. It sold recently. Whatever. It's a 2-story, 3-bedroom, 2-bath, blah 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 blah. Right? They're gonna justify their valuation. You need to justify yours as well, right? Why is the ARV going to be $700,000? Is that like a dream? Is that a hope and a prayer, or do you actually have a reason for that target, right? Usually, what people will do is comps, very very popular way to justify your valuation. Just find comps. I mean, there are other ways to technically, if you want to, you could use the income approach to value this property. You wouldn't value it at $700,000 with the amount of income it has. Pardon me. You would not do that, but you could value it that way as well and justify your valuation that way. Um, that would apply if this was a commercial property, right? So this being a residential deal, um, it's not really applicable. But on a commercial property, the income approach is actually probably how that property would be valued. And it's one of the great things about some of these commercial properties is because they're treated more like businesses, it's much, much easier to calculate what the after rental value will be and what you need to do to get it there, right? Because really the value of a commercial asset is all down to the rents received, right? That's what it is. It's about how much money it makes, right? So if I can get the rent up this much, it will increase the value that this much, right? So that's something that you can keep track of as well. But you have to get that estimate as accurate as possible. nothing bad will happen if you're off by a little bit, right? Like obviously if I said I'm targeting 700 and the bank comes back and says we'll refinance for 675, then yeah, that $25,000 less I'm gonna make sucks a little bit, but it's okay. If we use this example, for example, sorry, that's an awkward sentence. But if we use this as an example, I have $126,000, 893 $126,893 in profit for this deal, right? If I'm off by $25,000, then I only have $101,000 of profit in this deal, right? Which that does suck. That's 20% less profit, right? But I can live with that. Most likely, so can you. Now, it does hurt you a lot more if we're over here looking at liquid profit, right? If I thought that this deal was going to cost me $40,000, pardon me, and I am off by $25,000, and the deal's now going to cost me $65,000 out of pocket, which is almost a 50%. That's actually more than a 50% increase in my expense from what I was expecting, right? So you just have to be wary that this number is never going to be as accurate as you want it to be. You should try to keep it conservative and understand that like the more that you're off, that's going to determine basically your margin of safety, right? The more conservative you are in your target ARV using this sheet and doing these kinds of calculations, the more margin you will have for being wrong because you've already assumed kind of the worst in the valuation, right? And there are lots of times I know we did a deal where we thought the ARV was going to be here and it ended up being here, right? So you can definitely underestimate and then get a pleasant surprise that you're going to make more money off the deal than you were expecting to, as long as you weren't overconfident in your initial estimates, right? It's very easy to make more money than you expected if you're a little bit conservative. It's very hard to find more money if you were a little too loose with your numbers and now you need more money because you underestimated your costs or overestimated your profits, right? It's a much harder situation to deal with. So I guess I say that whenever I go through these analysis sheets, but all the same, right? Be prudent and use the caution in terms of your assumptions, right? Because you want to try to make them as accurate as possible because they're really what is going to inform the rest, right? The rest of this math here is um, interesting and useful, right? From a just understanding and planning perspective. But obviously, it doesn't determine whether or not you profit. That's the ARV and the purchase price are really the only two things, right? The last thing I'll say, I'm going to move on from the sheet here, but the last thing I will say about the sheet, unless there's some questions, is this is a really simple way to kind of say yay or nay on a property and a project if you set up a criteria for yourself, a financial criteria, I mean, right? Because this sheet is calculating what your profit is in real dollars as well as what your liquid profit is in terms of cash money, you can kind of sit down and say to yourself, well, I want to make $100,000 this year. Let's just say, right? That's what you say. Aside from my job, I mean, like I want to go and I'm going to make $100,000 on real estate this year. That's the 2022 game plan. Well, okay. You can find a property that'll have a profit of $100,000, and whenever you find a property that's going to be as or more profitable than $100,000, this property you should offer on, right? It becomes really simple, and you just keep offering on those properties until you get one, right? Because that's the game. Of course, you're going to find some properties that look like great burrs, and other people are going to see it too, and you're not going to get those properties, right? And you can't be too attached because the burr works at the price you've analyzed it at. And if you get into a bidding war and you pay $60,000 more than you expected, that might wipe out your profit entirely, right? Obviously, so it's something where you've got to know your market, do your analysis and make your offer, and then understand that a lot of those offers they're not gonna work out, right? And that's fine. I want to talk a little bit, just slightly. I just want to relate this a little bit to the stock market because I've been reading. I'm learning, guys. I'm reading some books on the stocks as well as on real estate as always, and I'm learning a little bit, just understanding. It's interesting to get a different perspective. And I've been learning about Warren Buffett, who I've talked about the other week, but I'm just gonna kind of reiterate a little bit of what he does and just to illustrate this point of you have to have a bit of patience when it comes to these investing activities, and that is um, Warren Buffett does something called options trading or options investing, I guess you could call it. Um, options are basically contracts about stocks, essentially. They're really buying and selling contracts of a sort. And what he does is he'll get put and call options, which are contracts, they're agreements to buy and agreements to sell at a certain point in the future. And he will use those to generate cash flow from potential opportunities. And so, what he does, for example, is he'll say, I want to buy, I don't know, Google as an example, right? I want to buy Google. We'll say, let's say Google's worth $1,000 a share. I have no idea what it's trading for. So let's say it's worth $1,000 a share. And he says, you know what? Pardon me. At $1,000, Google's too expensive. Google's too expensive. I can't make money at $1,000. Now, $900, we're talking. That's a 10% discount. I will buy Google all day long for $900, knowing that there are people who will buy it right now for 1,000. Now, think about this, right? Because I've said this before, but I'm going to reiterate it right now. Investing does not involve risk, because I'm telling you exactly how Warren Buffett invests right now. And you explain to me where the risk is. Google's worth $1,000. He's decided it's not worth more than $900 to him. At $900, he will buy Google all day long, but at $1,000, he's not willing to buy it. What Warren Buffett will do is he'll sell what are called call options. I think I'm not too sure. I'm pretty sure they're called call options. Anyways, he's selling the contracts that say he will buy your shares of Google in the future. Right. So basically, he usually sells the contract for a month or for 6 months or for 3 months that says, I will buy your shares at any point during this contract if you want me to for this price. Right. And so he sells that contract. It's a 10% discount on the market price of Google. He sells the contract, whatever, it's worth 2 or 3% of the value of the contract of the shares. So it's not a lot of money, but that's what he does. Now, a month goes by. If those shares go up in value, he did not buy. Not only did he not buy, but because he's invested in stocks, he was able to sell the options contract. So he made a little bit of money, right? That 2 or 3% of the value of the stocks. It's not much, but it's something. If the stock went down, then his option contracts are called by the people who bought them. And he now buys the shares at $900, which is a price that is 10% below the market value when he sold those contracts, and is a price that he's comfortable with. He's happy to pay. It's a discount, right? So he makes the money, right? So in this case, Warren Buffett, if the price of the thing he's trying to buy goes up outside of his price range, he does not buy. He doesn't do anything. Now, because he sold an options contract, he makes a bit of money in that situation, but he didn't make money off the movement of the stock. He made money off the selling of the contract, right? Which is a little different. If the stock goes sideways, it doesn't move anywhere. Again, he doesn't make any money off of the stock, but he did still make money off the sale of the contract. So he makes money that way, right? And then, of course, if the stock goes down, well, he buys the stock for $900, which he feels is 10% below the market price. And so he just got a great discount on a company that he wanted to own anyways. That's how Warren Buffett invests. Do you notice that there is no, it actually gets worse than that, because he does certain things that, like, just because he's got so much money and influence, like he can walk up to a company and be like, I'm gonna buy this many shares and you're gonna give me a discount, and they will give it to him, because it's a big deal when Warren Buffett buys your company. So he doesn't buy shares at the same price you and I do. Let's put it that way, right? And this is the thing, right? Is he is unwilling to pay the market price for these assets. You don't get ahead paying the market price for these assets. This is true also of real estate, right? You need to be unwilling to pay the market price for the assets. And how do you know what the market price is? Well, you need to know the market, right? That's the important thing. That's the one thing I can't give you. You know the market by analyzing, by sitting there and watching the market and participating. That's how you learn the market, right? And it doesn't take a long time, really, but you got to put your attention into it, right? You need to know the market, and then you need to say, I'm not willing to pay market price. And you have to understand that that statement is a commitment that means that more often than not, you're going to have to walk away, right? It means that oftentimes the deal is not going to work. And even though you invested time and energy into trying to make it work, you're going to have to walk away from it, right? That's just the truth. Probably maybe not that. Yeah, actually, probably 90% of the time, maybe even 95. Like one in maybe 10 or one in 20 times when you really have a deal that you feel good about, is it going to move forward and the price is going to remain such that you are happy to pay it? You feel like you're getting a discount, right? It is in the case of Warren Buffett, he is leveraging a return on time by leveraging the asset's time value. That's what they call it, and selling that with these contracts, so he can produce cash flow from the asset. Right? No, Warren Buffett buys a stock and he produces cash flow off of it. Why? Because cash flow is what investors seek, regardless of the type of investing that they're doing. He just happens to be the world's most prominent paper asset investor, right? But he still targets cash flow, just like you and I. It's the same thing, and that's you know what I find always so both ironic and frustrating about like financial media and just I guess just the financial knowledge in general, right? Is people think that Warren Buffett made his money and makes his money because he buys low and sells high. Like that's not what he does. It's true he does buy low and sell high. That is a consequence of what he's doing. But that's not his aim. His aim is not to make money off of the buy low and the sell high. That to him is a bonus. Right? He's making a lot of his money. I mean, I think Warren Buffett makes something like $2 or $3 billion a quarter selling options contracts, something like that. It's a very, very, very large number. Like it's billions of dollars a year just selling those contracts, not buying or selling it, just the contracts. That's it. Um, that's how he generates a lot of his income. And so you need to understand that rental income and cash flow, that's how you're also going to generate a lot of your income. And then to really get the ball rolling quickly, you're going to need to buy things with a little bit of a discount. That means knowing your market and knowing when it's a good deal and when it isn't a good deal. And finally, having that criteria, right? Again, if you say, and everybody's different, right? So please don't take my numbers too literally or anything, right? If you say I want to have $100,000 in real estate profits next year, this year, whatever, then that's your target. Boom, you find this deal. Maybe you say I want to have $500,000. Okay, boom. You're either going to need 4 deals like this one, or you're going to need to find maybe 2 deals that are twice as good as this one, or 1 deal that's 4 times as good as this one, right? You got to set your criteria. Obviously, like as someone who knows the market fairly decently in Sudbury, I'm not going to get 4 times this deal in Sudbury. So I know if I want to hit my $500,000, I'm going to need to do more, right? Because this deal just buying a property for $2 million that is going to refinance for 3.5 mil in Sudbury is possible. I'm sure there are some commercial properties that will do that, but for the most part, it's not likely to happen, and it's not in my price range to do so, right? But you can see here, yeah, okay. I now know what my profit is. I plug that in. I now know if the deal's good or not, and then I make my offers, right? And again, because I know psychologically it's like it's going to happen. Everybody gets caught up in that bidding war mentality, for lack of a better word, right? You want something. You've decided this is my thing, and nobody else can have it now, right? And if all you gotta do is spend a little bit more money to make sure nobody else gets it, then you're going to, right? That's that bidding war mentality. Uh, you just got to be cautious of that, right? It's not your friend, it's your enemy. That's your ego getting all involved in things and making a mess of stuff, and it's your enemy. It's not there to help you. It's there to hinder you. So that's it. That's the sheet in its totality. I hope everything is clear and well understood. Obviously, I don't hope, I'm confident you all already understand all the principles of a burr. So this should have been pretty straightforward for you. And like I said, I'm going to send this to you in just a second because this sheet is a little different from the one I sent this morning. Just it includes the mortgage calculator, which is funny because you can't actually see it on your screen. The sheet's going to look the same to you, but it does do that in the background now. So it'll be a little different. And I have to fix this. These need to be flipped around, but that's no big deal. I'll do that and send it over to you. So that takes care of that. I wanted to just really briefly, I guess, to end the seminar today, I wanted to talk just a little bit about gratitude. Uh, I mention mindset to you all the time, and I think it's the most important thing. It's funny, I was telling you last week about William Nickerson in that How I Turned $1,000 into $5 million by investing in real estate in my spare time. Terrible title, it's too long, but I was telling you about him and how he was doing that 100 years ago, and how he found success, in the 1920s and 30s and stuff, investing in real estate, and how interesting his story was, because his story parallels a lot of the things that you hear today, especially people telling you that it can't be done, that it's too risky, that the good opportunities were in the past, that, oh, that was possible for some people back in the day, but not for you now, right? Oh, that the banks won't give you money. Oh, that the interest rates are too high. Um, Essentially, the laundry list of excuses that you've all heard at this point, right? Talking to people about real estate, and of course, it's very difficult. Um, Maybe very difficult is not the right word, but it can be challenging sometimes to remain motivated when most people you speak to they're on a very average track, and I don't mean that in a disrespectful way. I just mean they're not interested in doing this sort of a thing, right? And not only are they not interested, because perhaps that's the wrong word. I think they probably are actually interested, but they don't understand that it's possible, right? They don't understand what is possible. They live inside of a box. Pardon me, a box of narrowly defined possibilities. The kind of box that says you can go to school and become a doctor or a lawyer or a teacher, or you can not go to school and become a janitor. Like, they live in that kind of a box, right? And you've met those types of people. You know them. Maybe they're family members, friends, might even be a spouse. Um, it's very important to disregard those people and that mindset and that mentality. Uh, those people might be well intentioned, but they're toxic. They're like your friend who's offering you cocaine at parties when you were 20, whatever. Very well intentioned, right? They wanted you to have a good time, but they weren't banking on the fact that by 24 you'd have a drug problem, right? Sometimes people are absolutely doing what they think is right for you, but it's absolutely the wrong thing, right? And a lot of the times, especially where money is concerned, we all have such, I shouldn't say we all, because I guess that's not quite true. But if you haven't spent a lot of time thinking about money, maybe talking to people who have money about money and understanding how they got it and what they have to do for it, um, then you can come away with a lot of very, very misguided beliefs about money and how it works and how the world works and what the world is. Um, and we all need to practice gratitude and appreciate. When I say gratitude, I mean see the world for what it is and appreciate it, right? I got up this morning, you know, and I rolled out of bed. I'm gonna be a little graphic, but you get up in the morning, you got to use the bathroom, and I did not have to risk my life at the edge of a river to take a leak, because there was some great dude many, many years ago, way before I was born, who invented the toilet, and there were many, many, many thousands, millions of men, really, who took that idea of the toilet and paired it with the idea of the sewer to give me a world where I can go take a crap and not even worry about where it ends up. I don't need to worry about stepping in it later. I don't need to worry about it getting in my food. I don't need to worry about it giving me diseases like cholera. None of that. I have gratitude for that. And not just for the fact that it exists, but for all of the thousands and millions of people who sacrifice to make sure that it exists. Right? And that's something that we often lack, is gratitude. Gratitude is very, very important, because it grounds us and it reminds us of just uh, how privileged we are, and how responsible we are for making the world better, how much work we have to do to make tomorrow better than today. I just said thank you to all the men. There were probably some women, but it was mostly men who built the sewers and the toilets that I so appreciate, right? And I do appreciate them, and I do appreciate those people who sacrificed to give me those things and continue to today, right? And then the question becomes, well, what is the thing I'm going to leave behind for my kids and their kids, right? It won't be sewers. Thankfully, somebody's already gotten to that, and that's not my skill set, right? But it's got to be something, right? And that's my duty. That's my responsibility to take care of. You know, um, I think that's very important, and I think that gratitude is important, not just for identifying things like like the sewers, right? But also just for all the blessings we have in our life. I was talking to someone at work the other day about it's just a very light conversation, but we kind of talked about minimum wage a little bit and this and that. And after the conversation, I was driving home from work and I was thinking about it. And minimum wage, to me, and this isn't a political statement, minimum wage is wrong. It's an immoral thing, right? And that's, again, I'm not saying that as an opinion. That's a statement of fact, and I'll tell you why it's a statement of fact. Um, if you, the way that I measure all morality, just me personally, is I do the island test, right? Is something right or wrong is totally dependent on whether or not you can do it when you're alone on an island. So, for example, freedom of speech, right? You have the right to talk. If you're on an island, you could talk. So, therefore, you do have the right to speak. That's absolutely true. You do have that right. You do not have the right to a minimum wage, right? And the reason you don't is very simple. If you're on an island and you want to sit on your butt and do nothing, nobody's going to pay you a minimum, or I guess that'd be a basic income instead, right? Nobody's going to pay you a basic income, sit on your butt doing nothing on an island, right? Similarly, no one's going to pay you on the island at all. You got to work for yourself. You have to be an entrepreneur on that island, right? You actually have the right to work for yourself, but you don't have the right to work for someone else, right? So the idea that you should get a minimum wage just kind of backwards, right? In my eyes, right? And that's true for everything, right? Do you have the right to defend yourself on an island? Well, yeah. If a pig attacks you and you've got a stick, you can definitely stab that pig, right? For sure, and you can even eat it, right? It's all yours, right? For sure, that's for sure. So I like the island test. It's a good test because basically it's just the question of, is what you're doing impacting other people? And usually the answer is no, then it's probably your right to do it. Even there are lots of people who try and tell you that it isn't, but those people are wrong, right? And conversely, there are things that they do impact other people, and people will tell you, well, this is absolutely my right. And it's like, no, it's not. Healthcare is not a right because you have to force somebody to give it to you. So no matter what you do, the best it can be is a privilege that you're stealing from somebody to pay for. That's all it can be, right? And I mean, that's what we do here. Anyways, I'm not trying to be political. I'm just saying practice the gratitude, right? When you sit down and you really appreciate that, hey, yeah, I could be a monkey in the jungle by myself having to get my own food, and I'm not. And actually, I can go to McDonald's or I can go to Wendy's or I can go to Tim Hortons, and basically, I can be a drooling moron, and people will pay me $15 an hour. Right? That's like $100 something a day. That is way more money than I need for food, right? Way more money than I need for food. It's probably enough money for food and shelter, though it'll be a crappy shelter, not a shelter in downtown Toronto, but all the same. And I still walk around the world ungrateful, and I do. I'm not sitting here telling you be grateful as if I'm like the great, happy, always grateful for the world person. I am not, unfortunately. It's a struggle. It's a practice. It's something I work on every day. But we really need to look around the world and instead of complaining, right? Instead of sitting down and saying $14.20 an hour is not enough. This is ridiculous. What are these slave wages? If you approach that from the exact opposite perspective of gratitude, you know how many people work at McDonald's for minimum wage who are grateful for that money versus how many people work at McDonald's for minimum wage who have no gratitude in their bodies. I almost guarantee you there's almost no one who works there for that amount who's grateful. I almost guarantee it. Almost everyone who works there for that amount is ungrateful. And I say that because if you go to McDonald's, I'm just going to pick McDonald's straight up as the example. If you go to McDonald's and you are grateful for your job and you have a good attitude and you show up every day and you work hard, they don't pay you minimum wage for more than like 3 to 6 months. McDonald's will give you more money. Not only will they give you more money, but if you're willing to work long term, they will educate you. They will get you your own damn McDonald's, right? The thing is that we go into these situations and whether it's McDonald's and it's work or whether it's investing in our property or whether it's buying our cars or whatever it is, we're going into these situations and the world, the TV, the people around us, everybody is just going, be upset, be miserable, be critical, look for the problem. And listen, you're all smart enough. You can find problems. There's no question about that. I've never understood why people think it's intelligent to point out the problem with something. It's easy to point out the problem with something. Why don't you point out the solution? Right? Because it's challenging to solve a problem. It's challenging to invent a toilet. It's challenging to build a sewer. And it's challenging to buy real estate and invest in it and fix it up and make a home for somebody. But somebody has to do it. And make no mistake, the people who do are well rewarded. right? So we all need to just spend some time focusing on our gratitude and understand that we've been blessed with a lot, and we may all be striving and endeavoring to turn that a lot into a lot more. But we need to appreciate what we have today and really what it took to have it. And when you do, you'll treat those things with respect. And if you treat things with respect, usually you take care of them. And I bet you if you treat your finances and your assets with respect and you take care of them, they in turn will take care of you. Um, that was kind of a nice little poetic ending. I didn't mean for that, but that is where I'm going to leave the seminar today. Um, Give me a couple of minutes, like 5-10 minutes maybe, just to fix up these one or two little errors I just caught, and then I will send you the spreadsheet right away so you can go start analyzing yourself right away. Um, they say it takes an average of 100 properties before you find one good investment. I think I told you this at the start of the year, but that's 2 properties per week that you should be analyzing. So you think about that and you go analyze some stuff. Maybe try to do 2 this week. By the end of the year, you should have found something that will profited you $100,000 or $200,000, and that'd be a beautiful thing, right? Because the world needs more people like you getting ahead and making things better, right? You buy a property, you fix it up. I know. We got people on welfare. We've helped out, right? It's a true thing. So go out there and make it happen, because there's a lot of Canadians right now who are struggling, and they're not gonna get ahead if someone doesn't help them out. That's our job, right? So, anyways, thank you for your time. I appreciate you being here and sharing your Sunday morning with me. As always, send me any questions or concerns you have by email or text or whatever, and I'll get back to you as soon as I can. And I hope I'll see you again next week. You have a wonderful day. Oh, wow. That's every time. How do I?
Thanks, Aaron.
Merci, Dylan. And yes.